So this is a video about personal guarantees, non-recourse or recourse debt, all the same thing. This is a very complicated topic, and I almost didn't want to do it just because it is so complicated, and these are supposed to be short videos. So I'm going to try my best to make some generalizations here to give you a working knowledge of why they're out there, and once you understand that, maybe it'll help you. Um, Either organize the way you think about your global financial picture or at least give you some more things to talk about if and when you're talking to a banker. And maybe it'll just further cement that you ought to just give us a call and let us take care of some of your debt for you. But at any rate, I was trying to figure out the best way to start describing why personal guarantees are even a thing, and I think it's pretty obvious for most people why they would put a personal guarantee on a loan. But maybe that's just because that banks always ask for that, and it's just become the norm. But the reality is, some of the banks or some of the lenders out there, um, mostly non-banks, most banks will most always ask for a personal guarantee, and will almost always get it. But why is there non-recourse debt? Why can't everything be non-recourse debt? So I thought about the best way to present that, and to me, it occurred that maybe the best place to start was just to think about where the money comes from for the loans that banks do or the loans that non-recourse lenders do. And this is a big generalization, but I'm just going to refer to banks as recourse lenders and a bucket of different non-bank lenders as non-recourse lenders. And those non-recourse lenders, and examples would be like insurance companies that have collected a large amount of cash from the insurance premiums they collect. I mean, large amounts of cash. Commercial mortgage-backed securities lenders. Um, some folks may be familiar with that, some not, but there are another primarily real estate related lending type of groups. And then there is private credit. Private credit kind of jumps in between both buckets. Some of them act just like banks, depending on how they do it, and some others act more like private equity firms or some of the other non-bank lenders. But we'll put them in that non-recourse uh, group of lenders. So starting with the banks. So why do banks always want a personal guarantee? And I say always because it's almost always they will ask for it. It doesn't matter how big the loan is or whatever. Will they get it all the time? No. But for the majority of the 1099 bankers, clients, small to medium sized bank or excuse me, businesses in the United States, 9 times out of 10 or 9.5 times out of 10, there's going to be a personal guarantee involved. And the reason is that the source of capital that banks use to make loans is our deposits. It's my deposits, your aunt and uncle's deposits, the pizza place down the street, all those deposits. And those are federally insured deposits. Um, and so highly regulated. And the reason that they're highly regulated, if you think about it, is that when we go down to the bank and we drop off some money to go into the vault there for deposits, there is this understanding, whether we understand it or not, and sign off on it or not. It happens, and it's just part of putting your money at a bank. But we agree that when we drop our money off there, we agree to let the bank turn around and take those funds and make loans, whether they're making a car loan, a student loan, a mortgage that they keep on their balance sheet, whatever that is. In this case, we're talking about commercial loans. So they have that money on their balance sheet. Regulatory bodies within the United States, there's several of them that regulate banks. Uh, Ultimately, they set some of the parameters for banks, and they sort of operate as a proxy for our approval to lend those funds. Our money is going out the door in loans, but I don't know that I've ever been contacted by my bank to say, "Hey, we're thinking about making this loan with the money you dropped off the other day. Are you okay with us making that loan?" So that doesn't happen. So we need something in place, some sort of structure in place that helps ensure that our money is going to be there when we need it to be there. We go down to the bank to withdraw some funds for something that we want to do. And although there's been a few runs on a few banks over the years that I was in lending, um, most often our loans, or excuse me, our deposits are there. And that's part of the game with having the regulatory bodies involved. Again, as I said earlier, they're federally insured to a certain level, so that they'll be there. But the primary, and this is again a big generalization here, but the primary parameters that regulatory bodies put on banks that are lending the deposits they gather from people in the community. The primary one is that every loan that goes out on the commercial side anyway, commercial loans really need to have three primary sources of repayment to prevent there from being any losses related to a loan. And those three sources of repayment are, and they are in this order, um, cash flow from the business, um, collateral. So the assets that a business puts up for the bank to be able to come in if the bank or if the loan is about to default or does default, the bank has the right to take possession of that collateral and sell it, and use those funds from selling it to pay off any balance of the loan. And then after that, if there's still a shortfall, the bank wants your personal guarantee that you will make personal assets available to cover the rest of it. And so it's through those three steps that a bank can say with a fair amount of certainty that yes, we went through that process of evaluating those three things, the certainty of the cash flow, the value of the collateral, and that there's going to be sufficient liquidity available via the personal guarantee should there be any shortfall from the first two. And if you watch any of the other videos, we've talked about the five C's of credit. There's three of them covered right there. Capacity, which is cash flow, collateral, which is collateral, and capital, which is the essentially your personal guarantee or the equity and everything that you put into your business or whatever the project is that you want the bank to fund. Non-recourse lenders, on the other hand, are not as regulated. There are some that are quite regulated, depending on how they go about lending their money and what they call themselves, but and how they raise the funds. But they're not using bank deposits per se. They are primarily using another source of funds, and those funds could be put into a bank, just like you and I put our funds in a bank to try to get some interest while they're in savings or whatever. Corporations, companies, investors, whoever, they have that option too. So, but they don't. They opt to put their money in with these companies who are going to turn around and lend it. And the idea is that they'll get a bigger return than that they would have gotten at the bank. So, by extension, there you should be able to figure out that typically the cost of funds that these lenders have, these non-bank lenders, are more costly to the lender than what a bank will pay us on our deposits. So they have to, in turn, charge a little bit higher rate on the loans that they do. But to offset that, what these types of lenders can do, because they're not regulated and because they don't have the deposits and all those other things that go along with it and have all the other strings, they will typically be much more focused on the capacity and collateral part. They want to make sure they know their borrower. They want to make sure the borrower is experienced, and they'll do that kind of level of understanding about who they're actually doing business with. But they're not as inclined to, for lack of a better term, put hooks into your personal assets. So in the example of a commercial real estate deal where somebody wants to acquire, say, an office building that has tenants in it that pay leases that would be used to service the debt. The lender is going to look at those leases, see where the cash flow is, and say, okay, there's enough of these leases here, and we feel like nobody's going to move out of this building and impact that amount of cash flow coming in. So that'll service the loan. We're good there. But in the unfortunate event, like a COVID or something like that happens, then all of a sudden, there's interruptions in those lease payments. Our loan isn't going to be paid. We're going to look then to the collateral to get our loan repaid so our investors can get paid back. And then it'll typically stop there. They do from time to time, will, as part of the structure of the loan or requirement of the loan, want a borrower to put some cash aside for um, a rainy day or for a situation like a COVID or something where there's 6 months or so that maybe there's not enough cash flow coming in to service the debt, as sort of a means as to act sort of as a proxy for that third source of repayment that'll keep the loan going while you try to get a new tenant in there using that example. But at the end of the day, that's the two different pools of money kind of show you why one is really about recourse and the other one is not so much. The primary reason why I'm sharing this with you on the 1099 Bankers website is that a lot of people uh, have some misconceptions about non-bank lenders or non-recourse lenders. And mostly those are related to um, the size of the loans that those lenders will do. A lot of times they do, in fact, have much larger minimums. They do some very, very, very large scale loans. Um, and a lot of times these non-recourse lenders are the only way to get something done for whatever reason. A bank or a group of banks doesn't want to do a loan for whatever reason. Lenders like this can go ahead and get that done. Um, but nowadays, those lenders are more than willing to do much smaller loans and bring those larger esoteric type of structures down market a little bit into the middle market space. There are non-recourse lenders out there for operating companies. A lot of folks don't know that. And in addition, probably the biggest thing is that most people don't know how to access these funds. These are not lenders that have branches on every corner or have commercials during sporting events and whatever. Every time you turn around, there's a billboard for a bank or it's on a bus or whatever. You really don't know how to get a hold of these people. We do. And we understand how they work. We understand how they underwrite. It's really all the same sort of fundamentals. If you just, as going back to that other video in our series here, where we talk about the 5 C's of credit, they still start and end there, and it's still a risk reward sort of arrangement. It's just the terms are a little bit different, and if you really try to understand where the money's coming from that is going to fund this loan, it really gives you the keys to figuring out who you're dealing with and what things they may find important and why one may want recourse and the other one may not. I guess my two parting thoughts are, one is that there are some lenders that you'll find, and sometimes banks, credit unions, that kind of thing, will offer a partial recourse sort of arrangement, or some people call it a triggering recourse or whatever. My personal opinion, and again, this is just my personal opinion, is that there really is no such thing as partial recourse. Either it's recourse or it's not. And I say that as somebody who would underwrite credit and look at somebody's or a company's full exposure, all the different loans they may have with different banks and so on. If I saw something that has had partial or triggering recourse to it, I would count that as a recourse loan and thereby um, having me dilute the value of whatever personal guarantee or guarantee or recourse that I was looking for. The second thing that I'll end with this, is that this is a very, especially in the partial recourse world, um, it's a very gray area, and there's a lot of negotiation that takes place there. And if you're looking at considering, or you get term sheets from somebody and there is a partial recourse component to it, I would strongly encourage you to contact your lawyer. Make sure your attorney is really strong in negotiating these, because it can be very complicated. And there are a lot of different definitions and certain things that need to be hammered out in order for that to work it in your favor the way it's supposed to. So anyway, hopefully you found that interesting and educational. Hopefully it's not too general, but hopefully it's general enough so that it's not something that anybody thinks that we're the end all be all resource in. But hopefully it's enough to get you started thinking about personal guarantees, recourse versus non-recourse debt. If we can help you in any way, if you're wanting to explore these different options and you think you may be in a situation where you actually do have the option, or you want to look at some other lenders, give us a call, or just go to our website, click on the set up a free consultation. That'll get you on my calendar or one of the other bankers on our team, and we'll have a discussion about it and see if we can't point you in the right direction and or just handle the whole thing for you. I'm Doug Bowman. I founded 1099 Bankers, and I look forward to chatting with you soon.